Hi everyone, my name's Darryl Panes, CEO at As Good as Gold Australia, and today I'm joined by my brother Brian and partner at As Good as Gold. And today we interviewed John Adams, former economic advisor to an Australian senator and now Chief Economist at As Good as Gold Australia. Last week we did 2 weeks ago we did an interview with John, and it was just a phenomenal response. We had something like 33,000 views, or have had to date. So obviously the content that was discussed on the day was really relevant to Australians. What we discussed, of course, was mainly the Australian economy, its current vulnerability. We discussed mortgage debt, we discussed household debt, and we discussed a 10-point plan that John constantly refers to, one that one can use in preparation for the difficult economic times that may lay ahead. And we also talked about holding sound money, that was precious metals, that always prevail in this environment. Today what I'd like to do is just make reference to some comments that have been made of late by some pretty influential people in the economic world, typically Janet Yellen, former Fed chairperson, who was quoted as saying, or referred to, it's time for alarm. The loan bubble starts to run amok. Also, Claudio Borio, who made at the IMF, who's been making strong reference to the fact that the economy is in decline. Gerald Celente, a famous trends forecaster, who's made reference to the fact that the US is heading for a major downturn, and he believes it'll be worse than the Great Depression. So I guess at this point I'd like to say welcome to John, because I think we've got a bit to discuss here, John.
Absolutely.
Yeah, I mean, it appears to me that there's a lot more interest being generated at the moment, and a lot of these comments are coming from some, as I said, really powerful people. I think it's gathering momentum. What are your thoughts?
So what I would say is that there's clear evidence that a lot of very rich people, and I would include Ray Dalio in that conversation, but also some either current or former senior policymakers, they are now sounding the alarm about the global debt bubble that I've been warning about. And obviously, the mantra I've been talking about for the last few years is we've got the biggest bubble in the history of Australia. At the same time, we've got the biggest bubble in the history of the world. So this bubble is now playing out in several economies, and obviously people can see the warning signs already coming ahead. And obviously this is why you're getting senior people around the world giving very explicit statements and warnings about it. But on the other hand, what are we seeing in the Australian press? We're seeing people talking about a soft landing in property, people talking about the Royal Commission tightening credit standards. We're seeing conversations about potential oversupply of apartments on the East Coast. This issue of interest-only loans coming to a head in 2019, 2020. But if you look at the 7:30 report from a few days ago, you had a prominent economist saying that house prices from the peak could fall about 10 to 20% over the next 24 to 36 months, and that there'll be no systemic crisis in the Australian economy. So if you bought at the top of the market, you may lose a bit of money, but otherwise, things are not going to, the sky's not going to fall in. And obviously, you're getting this big dichotomy between Yellen and the IMF and other people saying, no, there's a much more systemic crisis coming over the horizon, and yet Australians are being misled by the press and by certain economists who won't really reveal the real position of the economy, both here and around the world.
And I think we might be falling for it as well, because, it's the same old thing, isn't it? She'll be right, mate. We look back to 2007-8 and we seem to have escaped that reasonably unscathed. And I just sort of get the impression that we're pretty lax again going into the next phase.
Yeah, I would say that this issue of she'll be right, this complacency, which is at the centerpiece of Australian culture, it's been with us, for at least more than 120 years. If you look at the 1892 depression, the banks in London blew up, and then we got swept right through it in 1892. And then obviously you had the New York Stock Exchange blow up in 29. And then you had a major bank in Vienna go bankrupt in 1931, and we got swept through the Great Depression as well. So this is why I've been very public and very explicit in some of the warnings I've been trying to communicate, because I just see complacency from the press, I see propaganda, I see complacency and a lack of understanding and seriousness by parliamentarians and policymakers. And when you look at the underlying structure of the Australian economy and you look at economic history, from where we are today, it is not going to end well for a lot of people.
What I'd like to do to support that too is, if we could just for a moment, I want to revisit this particular article from the last interview. The rise of real estate and the best is yet to come. There is a reference in, now this is a major publication from the Advertiser here, as I said, a couple of months ago, but there's a reference here to median property values. We're talking going back 2007, and the strong reference is to, well, the value of real estate then, median property, $350,000. Now it's 330, my apologies, 330,000, now 455. So we're talking 2018. So it's a $125,000 increase in property values. So instead of looking up some government data, I thought what I would do is go and visit a friend who has an engineering business. So I started to do my own research. I wanted just to look at real wages and how they compared to this growth in the same period of time. And I said to my friend, who employs a number of people, been in business for a long time, I said, how much were you paying your machinists back in 2007? And he said, $26 an hour. And I said, what are you paying them now? And he said, 28 to just over 30. Now, 28 to 30, let's go for the top number, $30 an hour. That's around about an 18% increase in wages.
Yeah.
However, the property increases were around 38%.
Yeah.
So if we look at the gross income here, and we go back to that 18% growth, net, it would probably represent somewhere around 12%.
After taxes.
Yeah, after tax.
Yeah.
So we're looking at an impossible scenario here. And the longer this goes on, the worse it gets and the harder it is for everybody. And so I sat down and I thought about this, and I thought, okay, so if they increase interest rates, it makes it harder, obviously, for the person who's paying the mortgage.
Yeah.
And if they don't increase interest rates, we're just going to have more of the same. So it's just going to become unattainable.
Yes.
Right, so I asked the question here, this is my question. Is the RBA scared to increase interest rates? First question. Second question, is the RBA scared not to increase interest rates? I would like your response to that.
Sure. So the RBA's position has been that they use an inflation target measure of 2 to 3% over the medium term. We've had, according to the official CPI number, we've had relatively weak inflation. So they basically said, until we see inflation in the economy, we're not going to raise interest rates. But if you look at the history of interest rates since the last recession, in 1990, interest rates were at 15%, the official interest rates. And then where we are today, we're at 1.5%. So we are at record low official interest rates. Yeah. And at the same time, we've got the biggest bubble in the history of the country. So my view is that the long-term average, like over these past 28 years since the last recession, we had the average official interest rate was 5.1%. And the Reserve Bank cannot raise interest rates back to the long-term average because the bubble is so big. Because if they did that, hundreds of thousands, if not millions, would default on their mortgages, and we would have systemic crisis in the banking sector. So I think even if they wanted to, they can't, because the debt is enormous. And this, to me, they've trapped themselves into a corner by allowing all this debt to be in the economy, and they really can't get out of it. So they have their official reason for why they won't raise interest rates, but I think the real reason is that they're caught in a debt trap, and they know that if they raise interest rates too aggressively, that they're going to cause a lot of households to default, and that's going to have a systemic crisis.
So you're damned if you do, damned if you don't. Between a rock and a hard place, how else could one describe that? That's really the position they're in now, isn't it?
Yes.
Yeah.
Yes. But on the other hand, we're seeing aggressive moves by the U.S. Federal Reserve. I mean, in the last week or so, they again raised interest rates to take interest. The U.S. official interest rate to 2.25%. So historically, Australian interest rates officially have been higher than the Americans, but now the Americans are higher than us. So they're 2.25, we're 1.5. So we're starting to see that impact the exchange rate. So the exchange rate, I think I looked at this morning, was about 71 cents. So maybe about 12 months ago we were about 76. So you're starting to see that the interest rate differential is impacting the exchange rate, and I suspect that that the dollar will take some further beating because of this, because interest rates around the world are a little bit higher than where we are, and it's more attractive to put your money in other countries because you get a higher rate of return on your cash. I think that they may be forced at some point to raise interest rates to support the value of the dollar, but I think in the short term at least, the RBA has no intention to raise rates. And while rates are low, you're going to see continual strong borrowing, particularly among owner-occupier households.
Sure. Not much to look forward to either way.
Yep.
I wouldn't have thought.
John, I have another question, or I have a couple of questions coming up. Our background has been manufacturing engineering for 30, 40 years of our life, and over the last 18 years, I've looked at the manufacturing and the destruction of the manufacturing industry in Australia. I've seen the industries of motor vehicles, refrigerators, footwear industry, electrical goods industry, all this we've manufactured in Australia, and of course the clothing industry. Now, we seem to have replaced these with building roads, bridges, and even desalination plants. My question is, because we can't sell these items, we don't sell these to the general public, where does the money come from to pay for these? And what tricks does the government use to show a decrease in the annual deficit that we have got being presented so far?
So thanks for the question, Brian. I think you've raised a very important sort of issue that's been in play in the Australian economy for at least 2 decades. So the first part of the question is, if we've reduced our manufacturing sector, if we're importing a lot of things that we used to make for ourselves, and we're selling less of that sort of product overseas, how have we been able to keep the standard of living that we currently enjoy? And I think it's a bit of a myth. A lot of Australians think we are a rich country, but the reason why we've had this standard of living is that we've been borrowing enormous amounts of overseas money. And so if you go back to 1990, net foreign debt. So this is foreign debt after you consider our foreign assets, was about 133 billion.
Okay.
So in September of 1990, whereas today it is 1.036 trillion. So
Massive increase, isn't it?
So within 28 years, our foreign debt has increased tenfold, and a lot of that has been because of the sort of the massive expansion in the bubble that we have here. We've borrowed a lot of money. Part of it for capital investment, but also part of it for in terms of consumption. Whether it's borrowing for property, borrowing for lifestyle reasons. Obviously this is why household debt is out of control, but a lot of this has come through via the banking system. We need to get back to an economy where we have sound savings, that we have sound investment, and we actually make things that we can sort of make for ourselves and obviously export. So that's where in terms of the issue of the decline of the manufacturing sector and how that's actually impacted sort of our sort of structure of the economy. Now, in terms of the government, so particularly at the federal government level, since 2008 2007 when the Howard government left, so we've seen a massive increase in Commonwealth debt in this country, and that's obviously led to a massive spike in the federal government borrowing from overseas investors to fund these deficits. So one of the things that I think most Australians don't realise is that the government has quite a bit of expenditure off balance sheet. So there are certain categories of expenditure, particularly around infrastructure and investment, where if it's deemed that the government can make a commercial return on an investment, where that borrowing is not included on the balance sheet. So a classic example is the NBN. So when they came up with the design of the NBN, they thought they could make a commercial rate of return on the construction of the NBN, and therefore the borrowing, which has been in the tens of billions, was not included. So obviously, the government has been presenting numbers around the deficit, but to really understand, well, what have they been really doing? You've got to look at the debt statistics, and gross Commonwealth government debt is in the order of about $600 billion.
Okay, it seems as though the government can easily switch from one set of figures to another to achieve the result that they want. So my next part of that question was going to be, how do we start achieving a surplus in this country? Do you have any ideas on that level?
Well, so I'm a very big advocate of surplus budgets, and it just gets back to common sense. Expenditure has to be less than revenue. So we've got to tighten the belt. We've got to look at a place where we're spending that we think that in prudent times we shouldn't be spending, and we just got to cut spending. And obviously, there are probably sort of areas on the tax side where I think we need to keep sort of taxes low and flat to encourage work, to encourage investment, both domestically but also foreign investment as well. But it all comes down to spending. And when you've got record low interest rates and people think that there are no consequences to spending reckless amounts of money and the money grows on trees, you get an outbreak of expectations among the population as to what sort of lifestyle do they think what they think they deserve, but what they think government should be giving them as well. So and this is sort of what we're happening now. But I think what happens is, in any bubble, this sort of behaviour occurs, and then when a big economic crisis happens, expectations come back to reality, and then people reassess, well, what sort of lifestyle should they be getting genuinely, but also what can government really fund in sort of tough economic times.
That makes common sense. Yeah, absolutely. Thanks, John, for that question. John, another question for you. I have always liked a gold standard, but we seem to be right now in a debt-based economy. So we've been in this economy for a long time now, obviously since we've come off in 1971 when the United States came off the gold standard. But Australia has a debt-based economy. Do you think it is sustainable?
So the short answer is no. So the real hidden sort of story in terms of the Australian economy, particularly since the last recession, is everyone says we've had robust economic growth. We've had like good times, all of this sort of stuff. But the growth that we've experienced since the last recession has been fueled by record levels of debt. So when you look at household debt, when you look at foreign debt, this is why I say we have structural imbalances. But it is the debt that has resulted in all of this growth that has been occurring. So in a healthy economy, you should be seeing strong levels of saving, strong levels of investment, and obviously in productive investment that leads to sustainable long-term economic growth with sustainable living standards. But what we have seen is a misallocation of resources in the Australian economy, massive amounts of credit creation, whether it's through the Reserve Bank or the banks. We've been borrowing a lot of this money. A lot of that borrowed money has then resulted in record loads of consumption. That consumption then says that we are growing as an economy because people are consuming more. That's how the GDP is calculated, and so that's the basic process as to why we have in terms of a debt-based economy.
Okay. So does Australia make the decision that we have a debt-based society, or is it a world power? Is it an IMF or the World Bank? Who makes these decisions on a debt-based economy?
Well, yes, we have a debt-based economy, but I would say that the world has a debt-based economy as well. So I think your reference to 1971 is correct. So obviously in 1944, when the Bretton Woods system, when that was established, the US dollar was established as the world reserve currency because it was tied to gold. So from 44 to 71, it was deemed to be that we had a sort of anchor that was keeping sort of the global economy in some sort of relative balance. But since 71, you've got central banks around the world printing enormous amounts of fiat currency, and that has led to economic growth over those 40 years, but obviously it's resulted in the biggest debt bubble in the history of the world. So we've got 247 trillion of global debt, and relative to global GDP, I think it's in excess of about 300%. So our debt-based economy in Australia is operating on the same on the same sort of monetary heroin, if I could use that term, that the world has been operating on since 71. And obviously, central banks and certain academics think that this system is sustainable, that we can continue along this path. But if people want to understand why do we continue to have financial crashes, boom-bust economies, it is because we're having a fiat currency standard. And obviously this is why certain voices around the world are saying, well, the system we have now, it continually leads to bad outcomes. So should there be a reevaluation of the monetary standard we have?
The system that we have today.
Exactly, and we should look at something else. So this is where a lot of voices are saying.
So it's a question of a system where we have debt, or it's a system where we have savings to promote GDP.
Absolutely.
Right. Thank you very much, John.
John, when an economy is considered to be in a fragile state, as one could suggest now, the subject of bank stability always comes into question. Egon von Greyerz, Jim Rickards, David Morgan all talk about, when it comes to precious metals, taking physical possession, holding the metal, having it in your possession outside of the banking system. You go back to Lehman Brothers, GFC, you talk about the Cyprus bail-in. Obviously, or Australians should be concerned about how safe their money is. What I would like to ask you is, what is Australia's bail-in policy?
When you think about a bank balance sheet, a bank has assets, has its liabilities, and what's left over is the owner's equity. So the assets of the bank are basically the investment it holds and the loans that it's issued to customers. Then you think about the liability side. The liabilities are the deposits, also the financial products that the bank has sold, where people have invested in sort of hybrid securities or various debt instruments, or if the bank needs to borrow money from the capital markets, they issue bonds, and because the bank owes the bondholders their money, that's the liability. So basically, when a bank gets into trouble in a financial crisis, the assets of the bank fall. So it's either people defaulting on their loans to the bank, or the banks have made bad investments, and the value of those investments have fallen, whether it's derivatives or shares or whatever the case may be. So in the GFC, when you talk about Lehman Brothers, so obviously Lehman Brothers, Bear Stearns, and a couple other banks went bust, but to save the economic financial system at massive taxpayer expense, particularly in the United States, they had massive bailouts to keep the banks afloat. Now, a bailout is designed to offset the fall in assets by increasing owners' equity in the bank, so the bank doesn't become insolvent. So what policymakers thought of after the GFC was, well, if we have another GFC, we can't continue to go back to the taxpayer and then trying to bail out. So is there another way to keep the banks afloat in a crisis without having to rack up massive amounts of public debt? So this is where the bail-in question came in, and this is something that the G20 and its offshoot, the Financial Stability Board, has been looking at. So Australia has signed on to several communiques going back to 2010, which was in Seoul, and 2014 in Brisbane, where we agreed that we would be a part of an international bail-in framework. So the conversation at the time was, well, so the bail-in is to convert liabilities in the bank into owner's equity to keep the bank afloat. So at the time, we said, well, the G20 said, and we were basically saying something very consistent, that we would be interested in bailing in what they call hybrid securities, which is effectively a bond that has in the prospectus or the contract that it can be converted into shares in the bank. So that is the position of Australia today, that if you own a hybrid security, you are going to get an attractive rate of return compared to the average market, but there is a risk that if the bank is in distress, the security can be converted into shares in that bank. so you may lose some of the value of your investment. Now, obviously, what happened in Cyprus was that they just didn't bail out hybrid securities; they bailed in mum and dad deposits, and that obviously caused massive concern and a massive shock to confidence, not only in Cyprus but around the world. Because they said, if it can happen in Cyprus, can it happen elsewhere? So. There are several governments, so New Zealand, the European Union, and the United States, that have said that that mum and dad deposits are at risk if the banks get into trouble. Now, in the case of Europe, they have said that deposits over £100,000 could be at risk if the banks are in trouble. Now, when you look at Cyprus, the bail-in in Cyprus was if you had above 100,000 euros in the Bank of Cyprus, they took 47.5% of the cash and then gave you shares in exchange for that cash. Now, in New Zealand, they have said deposits are at risk, but they have not given a limit. They didn't say it's above a certain value amount. They just said if the banks are in trouble, we reserve the right to take your money and to prop the banks up. And again, this is to ensure that they don't have to increase public debt by asking the taxpayer to have a bailout. Now, earlier in 2018, the government passed Parliament passed a certain piece of legislation called the Financial Sector Legislation Amendment, Crisis Resolution Powers and Other Measures Act 2018. So this legislation was designed to give effect to Australia's commitment that they gave to the G20 in 2014. So we committed to having an international bail-in, framework, but for Australia to meet that commitment, we needed to represent that in domestic law. And so this legislation that passed the Parliament in February of this year was basically that legislation. So the government, so there was a lot of controversy about this legislation. A lot of people around the country were very active to say, what does this mean for my deposit? What are you government trying to do to me? So, the government, the Reserve Bank, APRA, ASIC, the Department of the Treasury in Canberra, they all said that this legislation is purely designed around hybrid securities, which is consistent with Australia's international commitment, and that mum and dad deposits are off the table. Now, there's certain legislation, so there's this critical section, Section 31, that talks about that so bail-in in the Australian law, it's referred to conversion and write-off provisions. So the basis said that you can convert or write off what they call additional Tier 1, Tier 2 capital, which is the capital structure of the bank. You've got your common equity, additional Tier 1 and Tier 2. So Tier 1, Tier 2 are more risky elements of owner's equity. And obviously your basic shares in the bank is your common equity. So you can bail in that if the terms are expressed that you can bail in. So, but then they have this language around any other instrument. Now, that language of any other instrument is causing some confusion among certain parts of the commentariat as to what does it actually mean. So I've looked into this issue myself, and in this piece of legislation, there was no definition of any other instrument. There was no definition of instrument. There was no definition of capital instrument. And this legislation, what it was designed to do was to amend the Banking Act. So in the Banking Act, again, no definition of instrument, no definition of capital instrument. So APRA, when they talk about instruments, they talk about capital instruments. And capital instruments, according to APRA's sort of documentation that I've reviewed, says that it doesn't include deposits. But if you look at the international financial reporting standards and how the Reserve Bank prepares its balance, like its financial statements, so from an accounting sense, financial instruments include deposits. So I guess the concern that I and a few people like Martin North from Digital Finance Analytics have is that in a crisis, if you're looking at one of the big banks potentially going under, and the government's saying, well, in order to stop a depression from occurring, we've got to keep the bank alive. Well, but we don't want to actually bail out the bank. How else can we do it? I guess for some people, there's a concern that APRA and the government could change its interpretation of this particular clause because it is vague, and bail in deposits over a certain amount in theory. And we've got the bank guarantee, the financial claim scheme, up to 250. So the first theory that I have is that if they were ever to bail in, it would be above 250. But we'd have to see what happens in the crisis. So I think that because the government has been vague in terms of what it actually says in the law, there is concern that that bank deposits could be a risk in terms of Australia, knowing that what happened in Cyprus, but knowing that New Zealand, the European Union, and the United States has said that deposits are on the table. So if people want an assurance about their deposit in the bank, I mean, I can't say hand on heart that your deposit is safe. I'm not saying that your deposit is at risk. I'm just saying that the law is unclear, and in a crisis, could the government reinterpret the legislation to suit its purposes of that time? I think they can, and I think that if Parliament can take action today to provide further clarity as to what the state of the law is, but so far they have refused to do so.
So we have a look at New Zealand. New Zealand to me seems a little close to home.
Yeah.
And correct me if I'm wrong, but they introduced what they call open bank resolution policy, I believe.
Right. Yes.
Now that, as you've just highlighted, seems to be an official bail-in policy.
It is, yes.
Okay. So how easy is it for a government to make a change in policy there? I mean, is it an easy process? Can it be done overnight? Or is it not possible to do that?
So I think there's a distinction between policy and law.
Yeah.
So the policy that you refer to is a policy of the New Zealand Central Bank.
Yeah.
So obviously, so you can change a policy, you can change a policy whenever. So obviously, if you want to change the law, you have to go through Parliament. You have got to go through a parliamentary process. So obviously, by the New Zealand putting this policy out, I mean, it is obviously consistent with in terms of New Zealand law, and New Zealand's interesting because they're perhaps the most transparent government in the world about bail-in. They have a website and they have explicitly said, if a bank is in trouble, this is the process. Your money could be potentially at risk. So there's a different philosophy in New Zealand, which is to say that you, the depositor, it is your money. You have to determine where the best place for your money is, and you have to assess the risk of having your money in one form of investment or another. Now, part of the challenge with bank deposits is there's what economists call asymmetric information. You don't know if a bank is in trouble. You don't know their real financial position. You've got their balance sheet, but you don't know what the real position is. I mean, because there's numerous examples in the last 20, 25 years where the Asian financial crisis, certain banks were in trouble, but they were too nervous to reveal to the market what the real position was because they didn't want to cause an economic meltdown. So how will you really know what the real position of the bank is? Now, Australia's a little bit different because in the Banking Act, APRA has a dual responsibility for depositors and for financial stability, whereas in New Zealand, there is no obligation to protect depositors. New Zealand says you're on your own, you figure it out. But obviously, in the law, I think there's a distinction between deposits and depositors. So if we got into a crisis and I said to you, Darryl, either you're going to lose all of your money, or if you're willing to take a 20% haircut, I'll give you 80%. If I give you that deal, which one are you going to take? So if that sort of thing happened, I mean, I think APRA could say, well, I did the best I can to help Darryl because I protected 80% of his money rather than him losing all of his money. So there's obviously a difference there. But in terms of in terms of the distinction between law and policy, so the law is a law, and obviously because the law is vague. The policy of the bank is to say at the moment it's hybrid securities, but the policy of APRA and the federal government could change if the circumstances require them to do so because they have legal wiggle room to get around it.
Wow. Plenty to think about, and a lot to be said for the Egon von Greyers and the Jim Rickards of this world taking possession of physical gold and silver. Then you're in control, aren't you? Absolutely. Yeah. Just before we wind this up, John, I'd really like to have a quick chat with you about silver generally. what we've noticed, and we have mentioned this in previous interviews, but it's becoming even more evident now. The world just doesn't have a lot of silver available for investment purposes. I know the ratio is 82 to 1 or thereabouts at the moment, and I know that it's been 15 to 1 for many years. It's for 5,000 years there's been 15 times as much silver under the Earth's crust as has been gold. So that's been the ongoing ratio. But right now they're only digging silver out at about 9 to 1. And a lot of that's going into industry, photovoltaic cells and iPads, iPhones, and all of that. Yeah. So what we've noted, and this is becoming quite concerning, that as we've had no difficulty placing orders on suppliers for 12 months. Yeah. Yeah. Right now we're having some difficulty. Perth Mint just ran out of silver just recently. They have advised us that they'll have 2019 Kangaroos back in stock very shortly. So they seem to be okay. But Sunshine Mint couldn't provide going back 3-4 weeks ago, and still can't give us a date as when they can start taking orders from us. So we've still got major concerns there, and they're a major supplier to us. Yeah. Yeah. We then went to Scottsdale as a backup, and they said, look, we can supply you X amount, and it's not a lot, it's 1,500 coins a week. Yeah. That's the max that we can provide you. So what we're running into roadblocks everywhere. Yeah. And I'm looking at this and I'm saying to myself, okay, all of a sudden there's a genuine interest in silver. Prices are very low, the demand's increased, but it's becoming more and more difficult to obtain. It's a little bit like what Jim Rickard said, tell me when it's all going to happen and then I'll just go and buy a chunk of silver or gold. But that isn't going to happen. So it seems, I'm looking at it right now and I'm thinking to myself, if silver went up to $20 spot US between now and the end of this year, I don't know where we'd get it from. So what I'm suggesting is Jim Rickards is right. Absolutely no doubt about this. And I'd suggest that people have got to start looking at it now. If they are thinking about delaying this process for any longer, you'd want to get it right now, because I don't know if it's just going to be available. Okay, JP Morgan have gone long. They've, I would suggest, had some impact on this market. What are your thoughts here, and what do you think is going to happen so far as availability is concerned over the next few months?
Sure. So there's probably a couple of points to make there is that, and I've heard obviously David Morgan make this comment in a couple of interviews. So if you look at the supply data from the Silver Institute, annual production of silver is actually falling, and has fallen since I think 2015. So obviously there is less silver being mined at the moment, particularly because of the price. And the price is close to mining costs. So miners are being squeezed. And obviously, if there's not much profit margin for miners, then they're not really going to ramp up production when the price is so low. Right. So you basically have that, but you still have relatively strong demand for silver. Although the demand over the last couple of years has been falling, but the demand has been higher compared to supply. So inventories are being run down. So there's a lot of commentary about JP Morgan. What is their real position? What is their real physical position? Is it 140 million ounces? I mean, Ted Butler in the last week said their real position is 775 million ounces. But the other interesting thing to note is that there are people around the world, but also central banks who are buying massive amounts of silver. I mean, like the Russian central bank. I mean, there's been a lot of commentary about how much gold the Russians have been buying, but the Russians have also been buying, a lot of silver to obviously to store in terms of their vaults. So I think you're seeing potentially a genuine physical squeeze in the market, because we're seeing that that supply is drying up, and yet that hasn't reflected in the international spot price, which is obviously determined by the COMEX and the LBMA. It will be interesting. So obviously if we see the price of silver go up, I mean, there could be certain people who are holding or hoarding the silver who may say, okay, at this price, maybe at $16, $17 US, I'm willing to go sell the silver I have. But it would appear that, whether it's Sunshine Mint or others, there seems to be some issue in terms of getting sufficient silver for those who wish to invest, and obviously if that continues, there could be some sort of very big price moves as the squeeze manifests itself in the global market.
Yeah, well, I just know that we're looking for alternative suppliers as quickly as we can find them at the moment, because we've just got to be prepared. Brian, you had a really interesting reference there to JP Morgan's position with silver.
Yeah, that's right, John. The three people have been mentioned here: David Morgan, Ted Butler, and we've come up with figures that JP Morgan may have figures of 750 to 800 million ounces. So this has been accumulating since the World Financial Crisis, 2008. And when JP Morgan bought out Bear Stearns.
Mm-hmm.
So the theory goes to say that they've been shorting silver, and that is why it's been going down. But JP Morgan now has accumulated in excess, somewhere between 150 million ounces to 800 million ounces. It is rather ironical that JP Morgan finished shorting the silver stock, or shorting silver, and now have gone long. And ironically, in the last 4 weeks, we've seen it, but the demand for silver is also going up. And also too, in Australia, we've had a 90 cents per ounce increase. And this is only in the last 4 weeks, and it's just about the same time as JP Morgan have gone long. What's your impressions that could have happened or is happening?
Sure. So the first thing to obviously say, and I think I just said it when I was in the previous answer to speaking to Darryl, is obviously there is different views as to what JP Morgan's actual physical holding is. David Morgan says about 145 million ounces. Ted Butler says 775 million. Then obviously, what David is saying is that there's a distinction between whether it's JP Morgan's money or client money. So obviously, what I would say is that I think there's a lack of transparency about who really holds what. And obviously that's leading to a lot of commentary and speculation in the market as to what is the real position. But obviously we are seeing that certain big players, central banks, certain bullion banks are actually buying a lot. But also what we're seeing is that an outbreak of inflation. So whether it's Venezuela, Argentina, Turkey today recorded inflation at 25%. Even though the Turks have been raising interest rates quite aggressively, the Turkish central bank. So you're seeing inflationary pressure in the developed and developing world, and obviously people are concerned that central banks are not getting control of the monetary system. We're seeing currencies in emerging markets collapse, and obviously people want physical gold and silver to protect their financial world.
It's a natural tendency to see silver and gold go up during these inflation times.
Exactly. So I think that if we continue to see a build-up of inflation, across a number of economies, a demand for physical gold or silver will continue, probably get stronger, and obviously with declining supply, low inventories. And certain suppliers struggling to meet retail demand, we could see a very significant squeeze in the silver market.
Thanks, John.
Interesting. I don't know if you did your sums on this, Brian, but a 90 cent increase on $800 million. 90 cents per...
800 million ounces is nearly $800 million.
It's nearly $800 million. It's not a bad day's work, is it, John?
Yeah. Absolutely.
As if the banks don't make enough money as it is. Yeah. A lot of information today, John. Once again, look, it's in closing, what I'd like to suggest is that once again you provided some outstanding information, and obviously the viewing public is enjoying that and supporting that point of view. We've got a lot coming up, John. We've got an event coming up on the 6th of October, 2 days' time.
That's right.
That'll be at the Highway. You'll be speaking there for pretty much the whole session. We've got a Q&A at the end of the session, but we've got two presentations prior to that. So really looking forward to that. We've got a Melbourne event coming up. Date to be specified. We'll be forwarding that information out within the next 24 hours. Busy times ahead.
Yes.
Thank you again, John, for your support. It's been fantastic.
No problems.
And to all of our viewers out there, we'd like to thank all of them for their wonderful support, and we look forward to catching up with them again real soon.
Thank you very much.
Thanks, John.
Thanks, John.